Hi everyone, welcome back to the channel, The College Process. Once again, I'm Ed from Principia Prep, and like every Friday, I'm going back onto the comment section here, answering all the questions you guys leave in the comment section here in video format, so that everyone has detailed answers to all their questions. So once again, if you're new to the channel, any questions you have, any questions you leave on any of the videos, I will answer those questions in video format like this and put it back here on YouTube so everyone has answers to all their questions. That being said, let's start off with the first question here from about 2 weeks ago, coming in from Queenie Girl here. If a loan is taken for the whole school year and then in the spring they move off campus, what happens to the extra money? Well, the way it works is this. When you guys take out any loans, whether it be private loans, federal loans, state loans, etc., those loans are typically broken into two separate disbursements, the fall disbursement and the spring disbursement. Now, what happens is the fall disbursement and the spring disbursement, each one of them must be okayed by the financial aid office and the billing office to be able to come in for that amount. So let's just say, as an example, essentially, let's just say you took out a $20,000 loan, and the school cost fall $10,000 and spring $10,000, with the caveat that you're living on campus, let's say. Now, if you did live on campus and the cost stayed at $10,000 for the fall, that loan would go in, all that money would be basically taken by the school to cover your costs, you're done. In the spring, if you move off campus, and let's say your bill goes from $10,000 down to $5,000, then what will happen is the school will let you take a little bit extra of that loan money, typically given to you in the form of a refund. However, they won't give you the whole $10,000. So essentially, the school itself at some point will more likely reduce the loan down based on the fact that those housing expense involved in the new bill. So if you're wondering, are they going to send the whole $10,000 or whatever that amount is for you in the spring? Very unlikely, especially since your budget's going to be dropping down because you're not a resident budget, your commuter budget now, which is much cheaper. And with that, let's go to the next question here from Nia from 2 weeks ago. Nia's question is, how are taxes paid on receiving large amounts of outside private scholarships for your daughter? Well, if you do receive scholarship money, as long as the scholarship money does not exceed the cost of the school as far as their cost of attendance, then you're fine. Let me use an example here for just make it easy for you guys. Let's say you guys have a school that costs $50,000 tuition and room board. That basically means direct costs, what you're directly paying to them. And let's say their cost of attendance, which is typically all that plus a couple more details as far as the books, transportation, buying a laptop, so on and so forth. Let's say the school's cost of attendance is $60,000. So essentially the school costs $50,000, what you're directly paying to them, but their total cost or cost of attendance is $60,000 because of other expenses, books, laptops, transportation, etc. So that basically means if you were to get up to $50,000 in scholarship money, then you're fine. It doesn't matter because you're still under the cost of attendance. Even if you were to get $55,000 in scholarship money, you'd still be fine because you're still under the cost of attendance. Once you break the cost of attendance limit, then you will be taxed on the extra scholarship money you receive. So let's just say that you were able to, luckily, between the school giving you scholarship money and outside scholarship monies, you guys made you guys obtained $65,000 in scholarship money. Then technically you're $5,000 over the cost of attendance. You can't actually do this. I mean, you can technically do this as far as taking the money in, but essentially what will happen is you're going to be taxed on that extra $5,000 because it's over the cost of the college expense. All right, next question here is coming in about the video we put up about the student loans, which ones to look at the top loans to consider for college cost. And the question coming in is, my son graduated early. He's only 17. Can he still take out a loan in his name with a cosigner? Yes, he can still take out a loan. Pretty much every loan, by the way, every loan you're looking to take out, other than the federal loan, will require the student to get a cosigner, whether it be state loans, private loans. The only time a student can technically take a loan out by themselves is when they're 25 years or older, and they typically are making around $50,000. That's like the limit I've ever seen a student be able to take out the loan by themselves, of where a student loan lender would provide a student their own loan without a cosigner, i.e. a parent in place. Okay. All right, next question here is about saving $10,000 or more in college cost each year. And the question is, how do I go about finding out if the courses that I would be taking, essentially, I guess, at community college will be accepted towards college credit? And the answer is very simple. You can either ask the admissions office, or if your student's already in college, you can ask their academic advisor. Either one of these two people, both admissions and the academic advisor, will be able to tell you what courses they do count, what courses they don't count, how much the credit will be, what GPAs they need coming in to count those credits. So those are the two departments you want to basically talk to, admissions and the student's academic advisor. Next question here is coming in from Nia again, asking about updates of the 24-25 FAFSA. There are a lot of changes happening in the 24-25 FAFSA. Unfortunately, I haven't had enough time to make the videos. One of the big changes, obviously, a lot of people know about is that they're actually reducing the question count, as well as they're pushing the date back till December 1st of start date for FAFSA, which is actually used to be October 1st. Now, I've actually talked about these things in other videos already. So many of you are already aware if you watched my webinars that I put out here on YouTube that I do for the high schools about these different things happening, specifically the reduction in questions on the FAFSA form. But I will be making FAFSA specific videos starting around September to get you guys ready knowing what's happening in the world of FAFSA, especially because of the delays, changing questions and changing form and everything else. And the next question here is from Mr. Austin. How will the new FAFSA value income versus wealth? For example, if we were to pay off the mortgage, lower wealth, if someone has 200,000 liquid assets, like a liquid savings, and has a family income of 120, would it make sense to pay off 50,000 of the balance with a 2.25, 2.25 mortgage? Let me see how I answer this. Unfortunately, I don't know very much about you, and I don't know what schools you're applying to. So in some cases, to be honest with you, even if you used up your whole $200,000 in savings with an income of 120,000, most state schools aren't going to give you any aid anyway. So the FAFSA is kind of irrelevant in that case situation. But if you're looking to basically build or create space for financial aid eligibility, yes, drawing down assets, the things you put on the FAFSA form, checking, savings, investments outside of retirement would help out. Obviously, especially since on the FAFSA, your home doesn't count, your equity in your primary property doesn't count at all. But unfortunately, without a college list, I really wouldn't be able to give you further information than that. But yes, drawing down or limiting the amount of stuff you put on the FAFSA that's being utilized, savings, checking, CDs, bonds, mutual funds, assets outside retirement, all these different things, if these were to be dwindled down, then yes, on the FAFSA form, you technically are creating space for financial aid. But unfortunately, just because you're creating space doesn't automatically mean that the school is going to give you financial aid assistance. So just some things to think about. Hopefully that answers your question that yes, drawing down savings will essentially allow you to create more financial aid space for colleges to consider you for financial aid consideration for free money, i.e. the grants. Next question here is, I have 2 kids going to college. Other than scholarships, they don't qualify for much. So do we borrow semester per kid or a year or all 4 years, etc.? Well, when it comes to taking out a loan, what you guys want to do is you essentially want to take out the loan for the whole academic year. So if we have 2 students going off to college, we're taking out 2 private loans or 2 state loans, whatever loans you go with. Each one of these loans are student specific, so you can't combine them together. So as a parent, you can't go out, get one loan, and then get that money and split it between the 2 of them. That's not the way it works. You must get a loan individually for each student. And you don't want to do it by semester. You want to do it by academic year to have them covered for the entire academic year. So whatever loan you're looking to go out for each student, you want to make sure they have their own individual loan to cover their own individual costs at that college. And more than likely, if you're looking to take out either a state loan or a private loan of any kind, you will need a cosign for both those students. As I mentioned before, students cannot take out loans by themselves other than the federal direct loans are already offered from filling out the FAFSA. Okay, next question here comes in from about 8 days ago. If we didn't get scholarships despite being eligible for it with both SAT scores, with both scores and SATs, then what can be done? Well, essentially the way it works is when you're dealing with any college and they're looking to give you scholarship money, it's based on their criteria. Now, most colleges will typically give scholarship money based on merit, based on typically academic achievement, GPA and test scores, in some cases just GPA. Now, if the school did not provide you scholarship money, you do believe you are eligible for scholarship money based on your academic profile, then what I would do is contact the admissions office, because the admissions office is the department that actually provides the scholarship funding. And if you believe there is a scholarship should be in place, I would be talking to them directly. Now, if they indicate that there is no reason for scholarship money, I would ask them why, based on the criteria that I have. Where am I deficient here? And admissions is actually pretty friendly. They're pretty open about everything. So I wouldn't think about it as kind of like combative, like you say no, I say yes, that's not that kind of situation. They're there to basically figure out, is there any way to give you scholarship money? Because the fact that the money's already there in the endowment, they're just looking to give it out to the students who are eligible for it based on the academic criteria required. Next question here. Hello, I got married and live with my spouse. How would that affect me? Well, it depends on who you are. Let me explain what I mean by that. If you're the student, then it does affect you in the sense that you must count your spouse's income with you as basically combined as married as a student. If you are talking about you have a student who's going to like a child's college, going to college, then that new spouse, a step parent, their information also does count. So if you're remarried and you have a child going to college, that new spouse, a step parent's income and assets will go on the financial aid form. If you're a student yourself and you've gotten remarried, then that new spouse, that income they're bringing in, those assets will also count on your FAFSA. Next question here. Hello, please, which other loan companies support students that want to study in UK and Australia? Now, if you're talking about you're a domestic student in the United States and you're looking to study abroad, most of the student loan companies will actually allow you to take out student loans and apply for colleges outside the US, outside the domestic US. If you're talking about you're a resident, you're in another country, let's say you live in UK or you live in Austria, and that's where you basically go to college, so on and so forth, then over there, the systems are going to be a little different. I would still look at the private lenders as an option, but the reality is good, bad, or indifferent. Some of the lenders will not provide if you're not if you're not domestic U.S. citizen, unfortunately. So I would check with the lenders. I would watch, and I will put in the description down below a link for the top 5 loans to consider this year for students going off to college, 23-24 academic year. That video here, which I'll put in the description once again, that link here will show you the best loans available to apply for to see if they are eligible for you if you are looking to go or if you do live outside the continental US, okay? But if you're a domestic student, pretty much all the lenders will provide for loans outside the domestic US. If you are a US resident going off and studying somewhere else, let's say study abroad type situation. Next question here comes in 2 days ago. First off, thank you for the valuable information. I have a question as follows. I'm thinking about applying to the Parent Plus loan for my daughter's student loan. To be said, I was wondering if it would be eligible to apply for the income-driven repayment. By the way, my income is around $80,000. I have a family of 4. I was also told the income repayment requires you make payments for 20 years and the remaining balance will be forgiven. Is that right? Well, let's start off with yes. The income, once you do any of the income repayment programs, once typically around 20 years, depending on the program, whether it's save or repay or pay or so on and so forth, many of them there after about 20 years will forgive the debt you have. However, the problem is that your income needs to be low enough for the program to make sense for you from this perspective. Most of the income repayment programs are really set up for incomes roughly around the 50,000 mark and below. The problem you're going to have is that you must apply for these programs every year and be accepted within these programs to be able to continue doing these programs. Some of them might actually kick you out if your income gets too high. Now, unfortunately, your income must stay low for all 20 years. So this is a very difficult thing to achieve from the perspective that in 20 years, obviously $80,000 of income is not going to be what $80,000 income is right now. So reality-wise, you want to keep increasing your income. So unfortunately, if you're looking at one of these income-driven repayment programs, your goal is really to utilize it for a little while, unless you know your career path will not be paying very much income whatsoever. And right now, you're pretty much on the higher end of even anyone ever can consider doing any of these programs. Typically around 50,000 or below, I would go forward with these programs. But anything higher than that, usually you want to get out of them because of the fact that most of the time the interest will be growing on itself for the amount you're not paying back. And if at any point in time they kick you out of the program because you got a bonus or you got an increase in income, you're going to have a problem in having to pay all this back, especially with all the increase of the interest being added on top. So I would highly suggest not considering this as a stepping stone or a procedure or path I would take. I would look at this as maybe a fallback just in case things don't work out. I would really be looking at, we're probably going to have to pay this loan back over the course of the standard 10-year repayment, which most of these loans are. That being said, let's go to the next question. Can a Parent Plus loan be taken out all year? Can a Parent Plus loan be taken out all year if needed? Yes, the Parent Plus loan can be taken out for the whole entire academic year, fall and spring, all in one loan, all at one time. And looks to be the last question here. We have the day here from 4 hours ago. Hello, sir. Can you give me a list of early action and early decision colleges? Unfortunately, I can't give you a list because the list doesn't actually exist because the colleges change their mind every year, essentially. What you would need to do if you want to know what schools offer early action, early decision, is contact your schools directly and ask the admissions office, will you be offering early action or early decision? Because there's so many different avenues of this. As you can see from the video, I talk about the differences in early action, early decision, regular, so on and so forth. Every school, every year changes their mind. 1 year, a school will do all early decision. Then they're going to do first choice. Then they decide to do restricted early action. Then they decide to do just early action. Some schools do all of it, early action, early decision, regular, rolling. So they're all different. So unfortunately, I can't give you a list because this is constantly changing. In some cases, not just every year, but every 6 months, schools decide when they're going to do and how they're going to do things as far as their admissions process. So I would suggest contacting the admissions office directly and asking them, are you doing early action or are you doing early decision? And they'll be able to tell you that information, to be honest with you, right over the phone. Okay. Other than that, thank you everyone for watching today. Once again, if you guys have any more questions, please leave them on the videos here. And every Friday, I'll be making these videos once again, putting them back on here with detailed information about all the questions you have, so then everyone has answers to all their questions. And other than that, on the screen, you see my contact information. If you need additional assistance or want one-on-one help, I do provide families with one-on-one assistance. through Zoom. All you need to do is just text me. That's actually my cell phone number, and texting is the fastest way to get a hold of me. To set up a meeting with me, you can even email me as well if you'd like. Other than that, thank you for watching today's video. Once again, my name is Ed from Principia Prep.